Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome, listeners and viewers, to episode number 136 of the Independent Advisors Podcast, where Mark McEvily and I, Matt Jessup, bring you everything you need to know from the past week in the world of financial markets and financial planning. This week, my guest is the one and only Nick Whitaker, who is our Director of Research and Trading here at Jessup Wealth Management. Welcome, Nick.
Good to be back.
I'm excited.
Yeah,
our last one was really good, so this one should be the same.
Absolutely.
And
that's the goal.
That is the goal. And then later on in the podcast, we have a guest for our financial planning topic of the week. We have Taylor Ledbetter. She is our paraplanner and wealth advisor here at Jessup Wealth Management, so she'll do that section.
Yep.
So we're having multiple guests today.
It's gonna be a good episode.
The trifecta.
That's right.
All right. So before we begin, Nick, you want to kick it off with pricing?
Yeah, absolutely. As always, as listeners know, we run through some pricing figures for everyone. So we're going to start with the S&P 500 for the month. We're up 1.46%. And for the year, we're still down 3.88%. The Dow Jones Industrial average for the month, we're up 1.73%. For the year, down 1.64%. For the NASDAQ Composite Index, we're up 1.51% on the month. And for the year, we're down 7.61%. The IWM ETF that tracks the Russell 2000 on the month, up 2.67%. On the year, down 7.12%. The Vanguard International ETF X the US is up 2.56% for the month and is up 0.1% for the year.
Bucking the trend.
That's right. And then our yields right now, and all of these numbers, I didn't mention this, I took as of 8:50 this morning. So your yields are going to be moving this morning with the CPI data. So
inflation data.
Yeah, yep. We'll change a little bit. But the 3-month T-bill yield is currently sitting at 0.288%. The 2-year Treasury yield currently sits at 1.424%. And the 10-year Treasury yield is sitting at 1.978%.
Hasn't broke that 2 yet.
Almost to the 2%.
Hasn't broke the 2 yet. I'm kind of surprised it hasn't, to be honest.
Yeah, particularly with the way the market was trending in January. And we'll see.
Yeah.
We'll see what happens.
Yeah. All right.
So switching into the big headlines and current events, what do you have for us?
Got a couple pieces here, Nick, for listeners. First is used car prices. Now, this is a hot button. Especially during the heat or the meat of the pandemic, right? You had a lot of supply chain issues, and what happened to the secondary market prices of used cars? Shot up to the roof.
Oh yeah, it was pretty crazy.
It was nuts. So this is what I have to share is after surging through the pandemic as much as 50%, 50, prices in the used car market showed some easing in the last 3 weeks of January. Now, Nick, this data is according to car shopping app Copilot, which tracks daily prices at dealerships across the country. And then the quote was, for just about every age bracket and segment, prices reached all-time highs in late 2021 and have started to level off and soften over the past month, a potential signaling of relief on the horizon for consumers in the car buying market, said Pat Ryan, the founder and CEO of Copilot. The price of a 2019 model have slid 2.5%. In 2020, we're down on average 4.4% from the high. So adding some real life, I would say, opinion to this piece. I'm friends with a gentleman that owns a used car dealership in town here. And the biggest problem that a lot of these people that own these dealerships is they don't want to carry a lot of inventory right now because they don't want to get stuck, holding a car they bought at the high and then having to resell that a couple months later when prices, if they continue this trajectory.
Right.
And so I think you're going to continue to see at least supply on these lots be low because in essence, the sentence that was told to me is I'm only going to buy something I know I can sell in 2 weeks.
Yeah, that's interesting to think about from that perspective.
It really is.
It's the inverse of what big box retailers were doing.
Exactly.
It's the exact inverse.
So, I mean, and the reason I want to share this with the listeners is when you're driving around and you still see you hear this, right? Prices are starting to come in. You would think, okay, supply must be going up. But I think you're going to see a lot of used car dealers that are going to continue to keep a lean inventory and only buy what they perceive that they can sell in a couple of weeks.
And I think based on what you're talking about and a couple of things that I'm talking about, one of the themes in here that we're going to talk about in the podcast is going to be almost normalization.
I think that's a good way of saying it, Nick. Yeah.
Is that like a fair way
that's
to think about it?
That's a fair way of kind of addressing kind of the point that we're at. I mean, you're going to have reversion to the mean on a lot of this stuff that was caused by COVID, supply chain inflation. And even with this huge headline number of inflation that we got this morning, the market is very forward looking. And I got a piece of data next week, and I'll just kind of give a preview. We've seen some of the largest outflows in January in inflationary protected securities. And normally people would buy that and hold them if they think inflation was going to continue at this rate.
Right.
And when you have such massive outflows within that sector, it tells me the big institutional money does not think that inflation is going to hang around.
Right.
Okay.
Right.
All right. My next thing is a check on the manufacturing sector. Okay. So this one, the data comes from the Institute of Supply Management. Most people see it in the news as ISM. On February 1st, Nick, they published their monthly manufacturing report for January. The latest headline number came in at 57.6. As a reminder for our regular listeners, anything above 50 is an expansionary territory from the previous month. What I want to focus on, specifically backlog orders. They came in at 56.4, down from 62.8 the prior month, showing that manufacturers are starting to catch up and the supply chain is getting better, though slowly. And what's the theme again?
Normalization.
Normalization.
Yeah, things going back to normal. Yeah.
And so, we have clients that own some manufacturing businesses, and I'm starting to get this feel. I don't have the actual numbers, but the sentiment that I'm getting is that they're starting to dig through their back orders. I'm getting that sentiment.
Yeah, and that 62 level from the prior month, that's a very high level. You don't see
above 60.
Yeah,
no.
Things cooking like that very often in a lot of the economic data.
No. And so to connect the dots, listeners, the reason that I'm highlighting this is, Nick, what happens when they eat through that backlog, right? And then so at that point, you could see prices start to come back down and then inflation start to cool. And I think this is part of the market forward looking. The market's not open yet. It's 9:19 on February 10th. I wouldn't be a bit surprised if the equity markets didn't react drastically to that hot number today because it is so forward looking. We'll see.
Yep.
I have not checked the futures yet this morning, but I wouldn't be surprised if it kind of looked past it.
Yeah, we'll see. I mean, with the volatility in the market, it could go either way.
Yeah, and I'm going to say at the very end, I'm going to give viewers a reminder that I don't think we're out of the woods yet from a volatility standpoint.
Yeah, and when we talk about another thing, I want to just clarify for listeners when we're saying, a trend of normalization, we're not back to normal, but you'll see some charts in this podcast and the show notes that you'll get a sense of what we're talking about. We're still working through the supply chain, but you can kind of see the light a little bit.
Yep.
So that's kind of what we mean when we're reverting to the mean, normalization.
It'll take several quarters.
Absolutely.
But we're starting to see the tea leaves of the data pointing that direction.
Exactly. That's what we mean.
All right, over to you, Nick.
So I only have one current event, big headlines, and it is also economic data, and it's a summary of the January jobs report. So
these job reports are hot these days. I mean, hot as in very watched closely by the market.
They are. And so I'm going to take a little bit of a deeper dive on this for listeners and just kind of explain the data in a little bit more in-depth fashion than I think we typically would. And so for a lot of listeners, you're going to know a lot of what I'm talking about. For some, you might not know any of it. Hopefully, you'll pick up, listeners will pick up something that they didn't know as I go through this.
This will be fun.
This is a summary of the January jobs report. A lot of this data I got from Trading Economics and then the actual BLS, Bureau of Labor Statistics.gov.
Okay.
So what is the actual data? You'll see non-farm payrolls, or you might see employment situation summary. That's what it's actually called on the BLS.gov website.
Okay.
It's an employment report that's released monthly on the first Friday of the month.
Correct.
So last Friday would have been the 4th, was this January report that we're talking about. So how is it collected? As I mentioned, it's the U.S. Department, it's the Bureau of Labor Statistics Department, and they have a program that's called the Current Employment Statistics Program. They survey about 140,000 businesses and government agencies, which represent almost 500,000 individual work sites. And they survey them in order to obtain industry data on employment, on hours worked, and on earnings of workers. So why is that important? It's important because it's hard data on the economy.
Yep.
You have employment changes by industry. You have average hours and earnings. You have the unemployment rate. You have duration rates of unemployment. You have so many different pieces of data in there, and it's hard data in that it is coming directly from a survey, factories, et cetera. Similar to the manufacturing data that you just went through, that's a harder data.
Sure.
Right. So again, why is it important? The stock market looks at this data really closely, as you mentioned. The stock market looks at it, the bond market looks at it, the U.S. dollar can react to it. So it's important from a reactionary point of view. It's important to get an understanding of how the economy's going, et cetera, et cetera.
Yeah, I would say it's one of the most important hard economic data points that is looked at by Wall Street on a monthly basis.
Particularly on a monthly basis. Yeah, absolutely. So what did this past month tell us, and why is it in the news? Because there's quite a bit of buzz around it.
Yep.
So the U.S. economy unexpectedly added 467,000 payrolls or jobs in January of 2022. And that was much better than the market forecast of 150,000.
Just blew it out of the water.
Blew it out of the water. And that happens every now and then. But this one was looked under a particular lens because of COVID and Omicron in general. So, leisure and hospitality was strong. Retail was strong. Wages increased. They're up 5.7% for the year. Unemployment ticked up 0.1%, but is still at 4%, so still in a strong range. The labor participation rate ticked up a little bit to 62.2%, and it was hovering around 63 in COVID. So you see what I'm talking about with the normalization. Exactly. So the reason that you saw a couple headlines, CNBC talked about it, and Wall Street Journal, Bloomberg, pick your source, but there were pretty big headlines on it. These January figures, they were a big surprise, as I mentioned, because of the Omicron variant. I mean, the White House even came out and warned that the data might be weak. So the data wasn't weak. The data was really strong. Everything looked good. So, the major takeaway being what? The economy's still strong. The economy was resilient in January despite Omicron concerns, despite a lot of people calling in sick and being required to stay home from getting a positive test. And then probably the more important part, and why the markets were looking at it so closely, and even the stock market kind of sold off the day before heading into it, and then recovered a little bit on the reaction. There was nothing in the report that would dissuade the Fed from hiking rates, right?
Yep.
And that's what Wall Street was really looking for. And even furthermore, what the street's a little concerned with is that in March, when the Fed comes out and most likely hikes rates, as the market anticipates, that not only will they hike 0.25%, they'll hike 0.5%.
It's possible.
It's possible. And this report was strong enough to where that is a possibility, and you kind of see that in the news and people considering that. We'll see what happens. Historically, that's not
not a normal move.
That's not a normal move. So historically, if it's just my opinion, I don't think they're going to do that. But there is talk that this data was so strong they could
justify it.
They could justify that
with
this kind of strength in the data. So a little bit of a deeper dive than we usually do, but
I think this is good for listeners. And my one comment I want to throw out there is the piece of data I pay a lot of attention to, besides the headline number of payroll gains or losses, is average hourly earnings gains, because I'm not sure if this statistic is still this figure I'm about to say, but it's going to be close. What I've heard is a 10 basis point, which would be 0.1% gain in average hourly earnings in a month, has the economic effect on the American economy of about 200,000 new jobs. And what I don't think is talked about enough is you see all these headline rates. But what's not talked about is, some months you'll get 10 bips, 20 bips in average hourly earnings gains. And that has a big domino purchasing effect across the U.S.
Absolutely.
And so I just want to throw that out there, that's something that I pay very close attention to besides the headline number.
Yeah, and I agree with you. I think that's a really important piece of the data that's released, that the news kind of shuffles under the rug a lot of the times. They don't really talk about it. I don't think they understand it.
Yeah. Well, I'm going to move on to tweets, articles, and research from the week. Nick, you want me to start?
Absolutely.
Okay, so I'm going to go first. One of my favorite data points for stocks, high yield bonds. Okay. So this piece of research, Nick, is from Bespoke Investment Group on January 28th. I have a chart associated with this that shows that high yield spreads have widened, but still remain relatively low to where they've been historically. We have a chart about this, okay? So, excuse me. So I'm going to read this narrative from the Bespoke note, and then you and I can have a little roundtable about it, okay?
Sounds good.
So starting off, this is what Bespoke says. When spreads are falling or low, equities are generally in good shape and unlikely to suffer major calamities. High yield spreads tend to be much more sensitive to the outlook than equities because they're more risk adverse investor base and lower position in the capital stack. As shown by the chart, over the past year, spreads have narrowed to the tightest level since prior to the global financial crisis. Spreads have been on the rise since. The recent bout of stock volatility has seen a widening of high yield premiums, risk premiums, that is worthy of note. That said, spreads have not taken out 52-week highs, and compared to other sell-offs, and they're being indicative of the market sell-off in January, Nick. So compared to other sell-offs in the post-Great Financial Crisis period, so post-2009, the current level of spreads are tight and not an indication of declining stocks. So the reason I put this in there is every, I think, true money manager has data points that they put more weight into others as their version of forward-looking indicators, right? And everyone, when you start slicing and dicing the bond market, right, you're going to have various ones that other managers prefer. One for me is, and I know our practice, we definitely keep a close eye on high yield bonds and their correlation to, investment grade as an example. And this is just something I want to put on the radar because I might have a piece in a week or two about this. But this is something that definitely I think needs to get more attention. Any comments on your part?
My comment, like most of my comments, it seems on the podcast, is that the chart does a lot for me, right? So I encourage listeners to check out the chart because you can really see what we're talking about when you reference it to 2008, and you kind of see that pop that we had recently, but it's back down into a solid zone.
Yeah, it's like they're yielding anywhere from 4 to 5% right now, low fours. Yeah. I remember when I started in the industry in '99. The average yield on like a high yield bond fund, and I'm not exaggerating, was like in the 11 to 12% range. And it's just crazy now how, people are like, oh, this company's not going to be able to afford 6% yields. It's like, give me a break. If they can't afford 6% yields, something's really wrong with the company.
Yeah.
I'm sorry. I mean,
exactly. Yeah.
My 2 cents.
Yeah.
But listeners, the reason I'm bringing this up, high yield, something we watch. You're going to hear more about this. Tell on the markets. Okay.
Yep. Absolutely.
All right. My next thing is forward-looking performance when sentiment is this bearish. So I love data like this because typically when sentiment is this bearish, you've already sold. You got cash on the sidelines. You're looking like everybody else when you're going to get back into the market. And so it's an opposite game of musical chairs. And this is, the two guiding emotions in finance, right? Fear and greed. You now have this aspect where fear is so high that if you're that fearful, you've tactically adjusted your portfolio, and most likely your equity portion or positioning is less than it has been. Hence, you have dry powder. And what does it take to push stock prices higher? Demand. And you need cash to do it. And it's my sense that it's that way right now. And everyone I feel on Wall Street's looking around. They're like early December, okay, who's going to buy before the end of the year? And it starts that money coming right back into the market. So what Bespoke did is they put some stats behind this, Nick, about sentiment. Now, this data in this chart, which is on our show notes, goes back to the year 2006. So it is pretty diverse, okay? Now, what you're going to show is we are at the lowest point since April of 2020. What happened in April of 2020, Nick?
Lowest level.
Lowest level. We were coming right out. The market was starting to recover from the COVID sell-off in February and March of 2020. Okay? Their data going back to 2006 says 1 month after market sentiment is this bearish, the average return, about 1%, and it's positive about 2/3 of the time. You go out to 3 months later for the S&P 500. On average, the market is up 2.5% roughly, and it's positive 72% of the time. You go 6 months out when bearish indicators are this bad. The average gain for the S&P is a little bit shy of 5%, and it's positive 74% of the time. And you go 1 year out, the average return for the S&P when things are this low on a sentiment basis, 9.5%, and it's positive 80% of the time. So here's my comments to you. There may not be blood in the streets quite yet, but investors have come extremely close to throwing in the towel. From a sentiment standpoint, it feels that way. Combining the net bullish sentiment readings from the leading sentiment surveys show that investor sentiment has not been this negative since the weeks coming out of COVID, like I mentioned earlier. Looking on the bright side, I like contrarian sentiment indicators like this to help me as a data point to quote unquote find the bottom. In prior periods over the last 15 years when bullishness was this low, the forward returns tend to be better than the average. Your comment?
I think that last point needs to be said again so listeners don't miss it, which is, what you just said. I'm going to just repeat it for
Go
listeners.
ahead, please.
In the prior periods over the last 15 years, when bullishness was this low, the forward returns tend to be better than the average.
That's right. And so, the comment that comes into my mind, when it feels comfortable to invest, the easy money's been made.
Absolutely.
And I'm not saying all the money's been made, right?
Yeah.
The easy money has been made, right?
Yes.
Where people tend to make larger forward-looking returns is hitting the buy button in times where it doesn't feel comfortable. I'm not insinuating now is the time to go all in. What I'm insinuating is that looking at the data sets, it tends to make more sense to buy when there's quote unquote blood in the streets. But why don't people do it? It's not comfortable. You have uncertainty. The market has to climb that wall of worry.
Yeah, I mean, for listeners, think about, the most recent one is obviously COVID, but you think about these massive pullbacks in the market throughout market history, and you just look at the S&P on a chart, and you can clearly see, oh, that was a massive pullback. That's kind of what we're talking about, and that's what this is saying, is when you have all these, these sentiment reports that are showing fear in the market, there's a lot of opportunity too. Right.
Absolutely.
Risk and reward.
Absolutely.
And that's what this is
because what
getting down
happens
to.
is there's a disconnection between underlying fundamentals of stocks and what their stock prices are representing. And I sent you a piece of research yesterday that showed all these earnings beats, these raising of guidance. And it just shows you how off or how bearish people are right now. Right. So I got one more to add to this. I'm going to turn it over to you. Another piece of research from Bespoke, and this part of their research note on January 28th was titled, Tackling the Question of, Well, is the Bull Market Over? You turn on a lot of the financial news networks right now. What's the conversation topic? Like every other good correction in the market. Is this the beginning of another 07, 08? Is this the beginning of another 2000 .com bust that takes the NASDAQ down peak to bottom 80%?
It increases their viewership and it increases their clicks, which is why they do that.
Of course.
Just to clarify
I
for
love
listeners.
that. So I'm going to put some data behind this. Hard data. All right. So listeners, the definition of a correction is a high water mark to bottom sell-off of 10%. That's the Wall Street's definition, Nick, as you know, of a correction. Okay. So what Bespoke did is they went and they looked at the SPY, which is an exchange-traded fund that tracks the S&P 500 index. Okay. And they looked at 10% declines going back to 1997. I didn't count them, but there's probably about 20 data sets here. Sound reasonable?
Yeah.
Okay.
Maybe more.
So what it does is it looks and says, after it bottoms, what is the average forward-looking return 1 year later? What is it 5 years later? And then what's that corresponding 5-year average? Okay. So this includes periods of the Great Financial Crisis. It includes the periods of the .com bust. Okay. The average 1 year forward-looking return after a correction in the market, 13.41%. That is above average for equity returns, as we were discussing in the prior data point about sentiment. You connecting the tea leaves yet?
I am.
All right, here we go. 5-year total return, I'll give the annualized in a minute, 61.38%. The equivalent annualized compounding rate of return, 9.11%. And I'm bringing it back, Jenna. That's not bearish. Okay? And I think when you look at periods of the market, and this is where the rubber hits the road for me, investors have to remember you have to endure times like this to earn returns that stocks and equities produce over the long term. If it was nice, even, steady returns month after month, quarter after quarter, the efficiencies of the market would be completely there and the returns would be nowhere near what they are for equities.
Right.
So what do you have to sacrifice, Nick? You have
Risk,
to sacrifice volatility, times when it doesn't feel comfortable to invest. And guess what? You're paying the piper in January. I'm sorry to tell you, it sucks. But you know what? As long as you own good quality investments, in my opinion, you'll be fine.
You'll be fine. Take a deep breath, and in 5 years, historically speaking, you will be just fine.
You know, exactly. You know, Mark's going to listen to this podcast, Jenna, and he's going to be like, Matt was on the soapbox again.
Yeah.
All right, Nick, I'm going to turn it over to you.
Well, I want to follow up with a couple points on everything with what you've been talking about, which is it kind of goes back to that last line in your previous tweet, which is, you know, a lot of times when you have these pullback in January, you know, 2020, any kind of correction in the market, it's natural for people to feel that fear and that angst because when you look at your portfolio, you lost, it's a lot of money, regardless of
the value of the account.
Regardless of the value of the account, it's a lot of money for everyone, right?
That's right.
Because that's your money.
That's right.
You lost a lot of it. But take a look at these show notes because it will make you feel a lot better, particularly this last one that you're talking about.
Absolutely.
When you have these max declines, I mean, you know, we mentioned, you know, the NASDAQ right here today is down 7%.
Year to date.
Year to date, right. So when you have these big declines, this chart, there's a lot of data, a lot of years in there. So
yeah, and I remember,
it's not the end of the world, historically speaking. You'll be just fine, and it's way better than keeping that money in the bank.
That's right, because I think long-term, 2 points I want to make to that. I'm just going to say it. What are people's alternatives to get these types of returns over the long term? There's really not much that makes sense.
There's not much that's feasible.
That's right. And then the thing on top of it that I'll say is, I know it's not comfortable, But again, that is the sacrifice you have to make. You can't have one without the other.
Right, exactly. You can't. I mean, if you could put it in your bank and get these returns, everyone would do it.
That's right.
Right.
But they're not there.
But they're not there. I think I earn a couple basis points on my
If you're
cash
lucky.
in the bank. Right. So, not much there. So
I'll turn it over to you.
yeah. So I'm gonna come back to the jobs, and I'll make this one quick since I've already kind of gone on my soapbox on jobs, so to speak. All right.
We need to get soapboxes, man. Like I'm talking old school soapboxes.
Yeah. So this is this research comes from Compound Advisors. Help me with his name, Charlie.
Charlie Bolello.
Thank you, Charlie Bolello.
He's awesome.
He's awesome. He has some great research, and I'll just tell listeners again, check out the chart. It says a lot. He talks about the payroll release, which we've already talked about, but the line I want to read is in March and April of 2020, 22 million jobs were lost.
22 million.
22 million. Since then, 19.1 million jobs have been added back.
I don't think anyone saw that coming. If we polled people in March and April of 2020 and we said, how long is it going to take to make a majority of these jobs back? People would not have said less than 2 years.
No, I wasn't saying less than 2 years. So, I mean, and I think the title on this was, is this the greatest jobs comeback in history? And this chart says a lot. And then it continues with another chart. So there's two charts for this one. So you get a buy one, get one.
I like this.
And Charlie continues and he says, the good news for anyone who's still unemployed, there's nearly 11 million job openings in the U.S., which exceeds the number of unemployed persons by 4.6 million.
That's amazing.
Which is a record high.
That's amazing.
Yeah.
You know what this means when I see this type of stuff? We need some immigration, baby. We need to get some people in this country. We need to get them to work. Well, let's get this economic engine. I'm talking, let's take it from third to fourth gear.
Hey, I'm into that. That's
what comes to my mind.
But what's going on with these charts and what we've talked about? There's two sides of what we've talked about on this podcast is, the fear in the market, the sell-off, the panic, what's going on. But a lot of the data points that we've talked about and that listeners can look at in the show notes for themselves, very strong economy.
And why would people be hiring? They need them. Their business is good.
Exactly.
That's not bearish.
Yeah, exactly.
Okay.
You're not hiring just for the sake of hiring.
You're not. No, you need
People
it.
don't do that.
Your company needs it because it's performing.
Exactly. So the next one I have is kind of coming back to fundamentals of the market, and it's checking in on earnings season. This is also from Charlie Bolello.
Oh, this is going to get me going, I think.
Compound Advisors. And
You
this
might
is
be
going to
poking
get
the
you.
bear.
This is going to get you
bear.
going. I already knew when you were talking earlier about, when you think about the strength of these companies and you think about the fundamentals and you think about what you were referencing to me with sending yesterday about all the corporates beating earnings.
I already apologized to Jenna. I'm going to get going on this. Go. This is going to be good.
And this is one where I'm not going to be able to do it justice. The chart does it for me. But it's just a chart of the S&P 500 EPS quarterly. And Charlie says overall, with 67% of the companies reported, S&P 500 earnings are coming in ahead of estimates and on pace for another record high. And
Another record high.
And so if you look at this chart, you can kind of see the trend since it goes from 2009 up to 2021. And so you can see that linear progression and how we're kind of coming back into that linear progression. If anything, we're actually a little bit above it, which just shows the amazing innovation of capitalists, or I should say of capitalism in these corporations. It's incredible to see this come back with everything that's been going on in the past 6 months, past year, and to see these numbers where they are today. I mean, that really speaks to how incredible some of these companies are to be able to pull that off.
So, beginning kind of my next rant.
Okay, here we go.
All
Here we go,
right.
listeners. Buckle in.
Do you know what really grinds my gears? It just really gets to my core, okay? Is when someone will make the comment, Well, Matt, how can you be so bearish? Look at everything going on out there, right? And you look at the underlying fundamentals.
Wait, how can you be so bearish or bullish?
I'm sorry, how can I be so bullish when things are so bad out in society? Okay. And I look at these raw statistics, okay? Earnings. That's a fact, Jack. Okay. So in 2020, in January, you had earnings on a quarterly basis in the teens. Okay. They are now on a quarterly basis in the 50s. So when someone says, oh, well, XYZ stock or XYZ equity index is up so much since 2020, it's not supported by the fundamentals. That really gets me going because they obviously have not done their homework. So that is a big misperception right now in the market that, in my opinion, over the long term, stock prices tend to follow earnings, earnings growth.
As they should. That
As
makes
they
sense.
should.
Right?
So when you see this massive move in actual earnings of S&P 500 companies, and someone says, well, it's not supported with the huge gains you've seen the last 2 years, that is blatantly false.
Yep.
And so the point I want to make here is this is a time in the market that I feel very strongly that people need to be looking at the stocks that they own, and they need to be asking this question. Is this company going to be able to continue earnings growth when the supply chain normalizes? Okay? Because there are a lot of stocks in the S&P where their earnings might be artificially inflated because they're able to get prices that are abnormally high right now. And an example would be anything that's inflationary sensitive. And you can kind of go down the line, and that's the concern that I have, is that there will be, in my personal opinion, areas of the market, stocks of the market that will continue to have that top line and bottom line growth on their revenue and net earnings. And there's others where they still might be producing 1,000 widgets a month, but the price they get for those 1,000 widgets as the supply chain normalizes, you have more supply come on the market, prices come down, that's going to affect their bottom line earnings.
Yep.
And so I want to throw this out there that we are moving more and more to a stock picker's market. Not all stocks, not all sectors are created equal. I think what has happened is the last couple of years, that tide has come in, it's lifted all boats. And I think you're in the midst of starting to see the tide roll out, and you're going to see who's exposed and who's not, who will not be averaging these types of prices.
Right. Exactly.
And so with that being said, listeners and viewers, don't fall into this camp that, well, how can the market sustain these gains? The earnings are showing you that they are.
Yeah. Check out this chart.
Oh my
if you're in that
gosh.
camp.
This
It will
is
help.
a nice looking chart.
It will ease the mind of anyone who's worried about valuations in the market if you look at this chart and just take a look.
It's like funny. Sometimes, talk to clients and they might make a comment, hey, you bought XYZ stock and it's near a 52-week high. Why did you do that? And, if Mark were here, he would say, it's not a 52-week high for a reason.
Yep. Yeah, absolutely. Absolutely.
Sorry, Jenna. Soapbox time. I'm 2 for 2 today.
2 for 2. All right, so I'm going to switch gears and talk about something different, which I know is on the minds of a lot of listeners and a lot of consumers and people in the market, and it's tightness in the commodities market.
Yep.
Now, this is a tweet I saw. It's from Liz Ann Saunders. She is the chief investment strategist at Charles Schwab.
She produces good stuff.
She does. And people might have seen her on some talk shows. I think she shows up on shows every now and
She's
then.
on Bloomberg a lot.
Is she?
I think so, yeah.
Yeah, and I know she's been on CNBC before, but and this is a tweet from yesterday, actually.
Fresh.
Yeah, fresh. Very fresh for listeners.
Hot off the press.
And it comes with a chart as well. And it says, no shortages of shortages, ... There are more commodities futures contracts trading in backwardation, in parentheses, indicating scarcity, than at any point since 1997. 19 of 28 raw materials. Now that includes anything from energy to grain.
Okay.
And what this chart shows is just basically a depiction of what she said. So there's a couple things in there that I'm going to break down for listeners. The first one, the most obvious one is, okay, what is backwardation?
Yep.
So backwardation is when the current price of an underlying asset is higher than the prices trading in the futures market.
Mm-hmm.
So it can occur as a result of high demand for any kind of asset or contracts that are maturing in the coming months.
Yep.
So what does this mean? It gets down to supply and demand, right? It gets down to a lot of what we saw in the supply chain with inflation over the past couple of years. It's a similar kind of concept, but just in the commodities market. You think about energy is the easiest example to kind of go through, but what's happened with the energy markets? And we talked about this a couple months ago on the podcast, but it has continued to go higher, crude trading in the high 80s, 90s, and people talking about, is it going to go to 100? Is it going to pass 100? And a lot of conversations in the market, and a lot of it gets down to the very simple macro and microeconomics of that you learned in your classes at school of supply and demand. And the energy markets, for example, there's just not enough supply out there, and the U.S. E&Ps and the U.S. Integrated companies aren't going to do it. They're not going to go and drill more. They're not going to go and pump more oil because Wall Street has told them you guys need to remain capital efficient and you guys need to remain disciplined.
Yes.
Because that's what's got you in trouble the past 10 years, which is why the S&P energy as a percentage of the S&P fell to 3%.
Yep.
Right. So it's not coming from there. There's geopolitical issues between Russia and everything that's going on there.
Stuff over in the Middle East.
But there's still demand. And so your supply has been somewhat stagnant, but demand has increased, particularly as economies around the world have begun to
Normalize.
That's right. So that's what this tweet is pointing out, that it's not just energy. It's in a lot of areas. 19 of 28 is what she says. And you can see this chart is pretty interesting. You can see it's kind of peaked out. And so this would kind of go against our theme in a way of normalization because the commodities market is so tight and everything that's going on there. But what I'd point out to listeners is that this stuff can correct itself pretty quickly.
Yes. My opinion with commodities is the faster it rises, the faster it falls.
Exactly.
High prices are the cure for high prices.
High prices are the cure for high prices. A perfect example is like what we saw in the summer with lumber.
Yes.
Right. We saw that. I mean, it was taken off and it came down pretty quick. It only took a couple months for it to chop off, 10, 15%.
And see, what I think happens is, you start to get Wall Street involved, and these people are buying futures contracts of which they have no intention of using the end product.
No, absolutely not.
So they're buying it just so they can flip it to someone else at a higher price. That within itself is a game of musical chairs. Eventually, along the line, someone's going to get burned, right? And I think that also causes the unraveling or the normalization in prices quicker.
Exactly. Yeah, you have people coming out and looking at this chart and saying, that doesn't make sense. How can I make money on it? And they go out and make money in the futures market. And someone's left holding the bag. Don't get me wrong.
Someone's going to take the financial losses on this.
It's not necessarily, I wouldn't call it easy money. It's very complicated and complex and difficult to analyze and do, but people do it.
Yep.
And so that's an interesting one for listeners.
This is interesting because, in my opinion, when I start looking at some of these tea leaves of where we stand with the supply chain, right? And last week in the podcast, I talked about, the cost to have a container ship, a container move from China to the U.S. or China over to Europe. And we are drastically down from the lows. From the highs or where they were last summer.
Yeah.
That's a leading indicator, okay? I see stuff like this, and it just tells me it's only a matter of time for supply to normalize, and people that are trying to flip these futures contracts are going to get burned at some point.
Yeah, they'll get burned. The market will return back to normal, but
prices will come down.
This chart is kind of a great example of what we talked about earlier, where it's like we're talking about normalization. We're not there yet. We're saying, oh, it looks like it's normalizing. It's going to take a couple quarters. This is one of those things that is not even close to normal yet.
No way.
And it will take a couple quarters. It
Absolutely.
will take some time for this to work itself out. But like this right here is actively an issue in multiple markets. It's driving inflation. It's driving up higher prices at the tank for consumers. I mean, there's a lot in there, but this kind of thing can and will normalize over the next year.
I would agree. And, real quick before we turn it over to the financial planning topic of the week, Nick, do you have any comments about like oil in the upcoming driving season? I keep seeing people trying to speculate that, as we normalize more and more in this post-COVID environment, I mean, you're seeing countries around the world dropping all mandates. And it feels like every other day there's another major country that's doing it. And as summer comes along, you might have a pretty robust summer traveling season. I'm not talking just airlines, but I'm also talking car driving. And I think that is oil is trading at where it's at with anticipation that's going to be the case. So I'm wondering how much of that's priced in already. And this is purely opinionated. How much of it's priced in and how much of it's not yet?
That's a great question. And from my time in the energy markets, I try very, very hard
not to
respond to questions like that.
Now I'm trying to poke the bear.
Right? It's very difficult when you get into that thing of, how priced in is the oil, is Brent and WTI, and will it come down in the summer? It's like, I've been on the phone with energy experts who tell me like, Nick, this summer it's happening. I'm telling you, the market's going to get in gear. It's going to realize how undervalued this space is. And, there's going to be more demand and supply is going to get in control and oil is going to go up to 60. And then it stayed at 40 for 6 more months. People much smarter than me. So that would be my response is, I don't know how priced in it is. I think it's probably some people are pricing that in a little bit to some degree, but I think a lot of it gets down to what I talked about earlier with just simple supply and demand, and particularly with the U.S. producers. They got hammered by their investors that told them, we want you guys to be disciplined, and you can see that in the earnings. It's flowing through to some of these earnings. Yeah. Where they're remaining disciplined, they're benefiting from the
higher prices right now.
Higher prices, of course, they're benefiting from it. But they're remaining disciplined and not pulling more oil out of the ground. So there will be some that get greedy. Yep. I guarantee it. Some will get greedy.
They'll pump more. The comment that I'll make is just in general, I think the risk reward just for the energy sector is given some of the moves in these stocks is the risk reward is higher. And so as much as you see the reward side, the risk is directly associated with it. And I'm not saying to avoid energy. I'm saying do your homework and be careful. That's kind of the message I want to send.
Yeah, absolutely. It's easy to get roped into that trade right now. It looks beautiful. It looks rosy.
Well, it's like anything else. It looks like it's going to, what always gives me pause is it looks like everyone's one-sided. It's going to continue in this fashion. Demand's going to continue to go up. Supply is going to be restricted. And when I see like everyone on one side, I want to take the other.
Yeah, exactly. Well, okay. Well, let's play this forward. This is purely hypothetical. Let's say a lot of the market is pricing in some of this summer travel season. And then a lot of the geopolitical uncertainties get sorted out and they hike the supply, and then the U.S. producers have already made plans to drill a little bit more. Not a lot, but a little bit more. What happens to the price of oil? It goes back down.
Come back down.
Now all of a sudden these earnings that we're talking about aren't as strong, and then one quarter comes, it could be 1 or 2 quarters, and then these, particularly your high beta names in the energy space, they will lose 25% of the gains that we've seen in the past year and a half.
I can see that.
And that's not an exaggeration as to how quick some of those small cap energy names
will
can
come
move. Now, I'm not talking about your big integrateds, but some of your smaller areas in the energy name, they can move there in the energy markets. They can move that quick. I've seen it.
Yeah, I mean, you were an equity surveillance analyst in that sector.
Yeah.
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 Well, before we wrap up your portion of the podcast, Nick, any other closing thoughts before I transition over to Taylor?
No, nothing else. I hope listeners enjoyed it, and thanks for having me as always.
Nick, you're awesome, man.
I appreciate it. It's fun.
I always love your viewpoints.
Oh, yeah.
So as we kind of transition now over to Taylor, I'm going to provide some background on Taylor. She's new to the podcast, by no means new to the firm. So Taylor has worked her way up through the firm. She's currently a wealth advisor at the firm. She also does all of our financial planning at the firm. So full name, Taylor Ledbetter, grad of the Wright State University. She has 2 degrees there. One of the degrees I have, the financial services degree. She also has a degree in accounting from Wright State. So Taylor, welcome to the podcast.
Thank you. I'm happy to be here.
So Taylor, what have you selected this week for the financial planning topic of the week for listeners?
Yeah, so today I'm going to talk about tax-efficient withdrawal strategies in retirement.
Okay.
And I think this is really important to talk about because you save your whole life, invest, and plan for retirement. But it's also important to know that just because you reach retirement age, those financial goals don't stop there. And there are still ways to maximize that income in a very tax-efficient way.
Yeah, I don't think this gets enough focus, Taylor, because I think a lot of people think, okay, I'm going to retire, but they really don't focus on what's the most efficient way to get those withdrawals to pay your living expenses. Mm-hmm. I'm glad you selected this.
Yeah, and I'm going to talk about 3 different strategies today and kind of give my 2 cents on those.
You're the expert in this area. I'll turn it over to you.
So the first one is called a traditional withdrawal strategy.
Okay.
And you start out by spending down those taxable accounts. So this is going to be an individual brokerage account. Anything that's taxed at a capital gain.
Okay.
After that account is spent down, you move on to your pre-tax account. So an IRA, 401k, anything that's taxed as ordinary income.
Got it.
And then lastly, you spend down those Roth accounts. And this allows the IRA and the Roth to grow more tax efficiently.
Yep.
But the problem with this strategy is that it doesn't minimize required minimum distributions because those traditional IRA assets are left untouched in the beginning of retirement. So you're left with a very large IRA combined with a high RMD, which creates high taxes.
Yep.
And there's also no tax diversification either because you're depleting one account at a time and you're only left with a Roth.
And that's what you see traditionally kind of occur, correct?
Yeah, it's a very simplistic strategy, but personally not my favorite.
Okay.
So the next strategy is called a proportional approach strategy.
All right.
This draws a little bit of money from your IRA early on in retirement so that the account is smaller in later years, while also drawing a little bit from a taxable account so your tax brackets aren't too high. So these IRA assets remain lower throughout this strategy, while taxable assets remain a little bit higher than they are in the traditional approach.
Makes sense.
This lowers RMDs in later years, and generally you spread out that tax diversification over retirement.
I mean, that makes sense to me. Mm-hmm. Yeah, I like that one.
Yeah, I like that, I think, better than the traditional strategy.
Yeah, I do too. And, with RMD age getting pushed back to 72, I think you're seeing a lot of people have these higher balances in their 70s, and all of a sudden you hit your 80s. I mean, we got clients sometimes that have 6-figure RMDs. Mm-hmm. And as you were indicating, that's ordinary income. There's really no tax strategy, Taylor, that you'd be able to advise them to shelter that. There's nothing they can do.
Yeah, there's nothing you can do.
You got to pay the piper at that point.
Yep, and you have no option.
And that's why I think the proportional approach strategy is more attractive.
Mm-hmm.
Makes sense?
I agree. And I also think everybody's situation is so individualistic.
Mm-hmm.
So, there's not one strategy that's right for everybody. It really just depends on your financial situation too.
Yeah, and one thing that can come into play is, say, age difference of spouses. So if you have a younger spouse who's going to inherit that account, you might recommend a different withdrawal strategy than if that weren't the case. I mean, there's a lot of variables that go into that.
Yep, exactly. And you may or may not be taking Social Security yet.
Good point.
You may not be at an RMD age, so other income sources is also, I think, a factor to consider.
Okay, that's good.
The last strategy is personally my favorite. It's called the Roth conversion withdrawal strategy.
Okay.
And the idea for this is to convert some of that pre-tax IRA money into your Roth IRA in the early years of retirement. This takes advantage of your lower tax brackets because you may not be taking Social Security yet.
Good point.
And you're not at an RMD age. And while you're making this conversion, you live off of your taxable account and pay any additional taxes generated from the conversion from your taxable account. And you want to convert just enough so that you're not bumped up into the next tax bracket.
I see you in meetings talk more and more about this strategy to clients. I really do.
Yeah, I like this strategy, and it's actually something I've utilized for clients in the past.
It makes a lot of sense. And so when you do that Roth conversion, you're not forced to pay the tax by taking more money out of the traditional IRA. You can pay, quote unquote, the tax bill from after-tax assets. Hence, you're lowering that taxable income by doing so.
Yeah, and that's the advantage. That's the ideal situation. You could always pay those taxes from the amount that you're converting, but that just means you'll have less assets to grow in that Roth IRA.
Exactly.
So ideally, it'd be great if you could take those taxes from a taxable account, but if not, it's not the end of the world.
Okay. Anything else regarding the Roth conversion strategy?
No, not necessarily. Like I said, I think that there are factors to consider when picking a strategy for you. One could be those available taxable assets because, like I just mentioned in the Roth strategy, you use those taxable assets to pay those taxes on the conversion. The size of the pre-tax account also matters because if you have a really low pre-tax account, you don't have much to convert. Or if you have, a really high pre-tax account, then a conversion may be best for you.
Yeah, and thinking about the available taxable assets, one thing I would love to have you back on to discuss is taxation of capital gains. Because I believe it is a misconception by the investing public that no matter what tax bracket you're in, people keep hearing that they're taxed at 20% for long-term capital gains. And that's not necessarily accurate.
Right. Yeah, those tax rates are actually 0%, 15%, and 20%, all depending on your income.
And I think there's a lot of people, Taylor, that actually don't fall into the 20% range, and they just don't know it.
Yeah, I see more people in the 0% range and a few in the 15% range.
Isn't that something?
Yeah.
And so I don't think that's talked enough about. And so I want to have you back on, and I want to focus specifically on that topic as well.
Yeah, I think that'd be great.
Because think about that. If you're able to sell a highly appreciated asset with no taxable gain, use that to pay your Roth conversion tax bill, that's a home run.
Yeah.
And see, that's the type of stuff from a financial planning standpoint that I think does not get enough talk or interest from the investing public. I think it's a lot more fun to talk about how this stock is performing, what the index is doing, talk about the equity markets. Not enough time goes into these withdrawal strategies for retirees.
Yeah. And that's why I chose this topic, is because I think it is super important, but it's not thought about enough.
It's kind of like an afterthought. It feels like it in our industry in general. Anything else on the factors for your strategy?
Other income sources, like I mentioned, Social Security, maybe if you have a pension, that's also something to consider, and your legacy goals, who you plan on leaving these accounts to, maybe your time horizon. There's just many factors to consider.
So when talking about legacy goals, your last point, this is a big one for me that I talk to clients about, because what I'll tell them is the most efficient way to leave money to the next generation is through that Roth account, because you're going to have all this compounding growth while you're still with us. And when that money goes to the next generation, yes, they're going to have to withdraw it within a 10-year period, but guess what? All those withdrawals are completely tax-free. And what a lot of clients are realizing, that as they get older, most likely their children are going to be in their prime working years or right near that. Hence, their tax bracket is going to be higher than theirs. And when that money goes to the next generation and they start taking withdrawals and it comes out completely tax-free, that is absolutely amazing.
Yeah, and that would be one advantage for doing the Roth conversion, is if you have some heirs you plan to leave that money to, like you said, if they're in their highest paying years, it's best to have that money in a Roth versus a traditional IRA.
The other thing that comes to mind with this, Taylor, is when I talk to clients about this aspect and we talk about, okay, let's make this Roth IRA more of a priority to pass wealth to the next generation. I think I usually transition the conversation to what the level of risk should be in that account. And I posture the conversation towards, we need to be thinking of investing that Roth IRA more like your kids would, rather than how you would at the age of 75, 80, or 85.
Yeah, more aggressive.
More aggressive. Because if your mindset is passing wealth on to the next generation, I'm not going to touch this account, I'm financially stable, it makes sense to walk down that road and consider having that account more aggressive, because we're treating it as if it's the risk tolerance, time horizon goals of the child rather than the parent.
Yeah, and that's a good point to add too.
Yeah. I mean, I think that's one thing that I like to bring up in those meetings, as I can start to identify what assets that most likely the parents aren't going to spend or need during their lifetime. Then we need to readjust the level of aggressiveness in that account then that matches who the beneficiary is. Right?
Yep. And typically you see, Roth accounts maybe being one of the last accounts you withdraw from. So that has time to grow tax-free. So, allocating it as aggressive is very advantageous.
Absolutely. So the one thing I'll kind of finish up on the Roth topic, this would be a good year. I would recommend people, Taylor, review their beneficiaries. So I know as a practice, this is going to be a big push for us, and there might not be any changes, but just making sure you got contingents listed. I mean, this is a time, this would be a good year to go through, check who's listed on your beneficiaries, and make sure it's the people you want it to be. Maybe you've had some grandkids and maybe you want to list them for 5% of the Roth. I mean, there's things that you could maybe incorporate there that you weren't thinking about, say, 5 or 10 years ago.
Oh, yeah, definitely. I think adding primaries and contingents are one of the most important things that you can do.
And I just don't think it's looked at enough. I think it's like, well, that's account open, it's fine.
Yeah.
Right? And they never really review those beneficiaries. So that's something else that comes into mind, especially with thinking of legacy asset transition. These are direct transfer products. They do not, if you have someone physically listed, they don't go through the probate process. So it's up to you to make sure you have the right beneficiaries listed, that most likely they're probably not going to go through your will or trust. Right?
Yep. Very, very important.
Any other items you'd like to add to this topic?
No, I think we covered all the basic points.
Well, either next week or the week after, we'll check your availability. I want you to come back and I want you to talk about taxation on selling stock in an after-tax account.
Yeah, that'd
because
be great.
again, I think that perception is there. It's 20%, and that's not necessarily the fact.
No, not normally.
Love it. Well, Taylor, thank you for being our special guest this week on the financial planning topic of the week. You're an absolute rock star. Appreciate everything you do for the firm. So I'm going to go ahead and sign off. Thank you, listeners, for listening to episode 136 of the Independent Advisors Podcast. We hope you have a wonderful rest of your week, and we will see you next week.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved. Advisory services offered through Commonwealth Financial Network, a registered investment advisor.